Hello, and thank you for viewing. This is Dan Perkins, and this is a video blog of Money in Motion. I thought I'd take just a moment to talk to you about what happened today in both the debt and equity markets. As you know, the stock market was off about 3%, and most of the major markets around the world were off, primarily again because concern about Greece and a possible default in Europe. That spilled over in the United States with the Moody's downgrading several of the major money center banks' debt offerings. So that the market got very nervous and sold off sharply towards the close. And we found ourselves down almost 3% for the day. Conversely, the Federal Reserve announced at 2:15 this afternoon that they were going to put in a new quantitative easing program, even though they didn't call it that, where they were going to begin to sell their short-dated to 5-year securities and begin the process of purchasing 6 to 30-year securities to the tune of about $400 billion. Their objective here was to try and lock in lower interest rates to encourage businesses to borrow and for consumers to borrow at very attractive returns. I believe the primary move here was to try and get something positive going in the housing market. However, I think the market already anticipated this quantitative easing move, and the bond market, which was the 10-year, which was about 193 before the Fed announced, dropped to about 183 to 184 after the Fed announced. So 10 basis points, 1/10 of 1%, but not a significant move. I have grave concerns that given the bank's experience with the mortgage business and what I've been hearing, the demands for mortgages, while theoretically could be high because of much lower interest rates, and I would expect to see the 30-year conventional conforming mortgage loan probably to be below 4% within the next few days. The decline in the value of the properties has made it more difficult for some people to be able to refinance, even if they had an attractive rate. So the activity as far as buying or refinancing may not be there in the way the Fed anticipated. I've warned you in blogs and notes to you over the last year or so that I thought we were in a very volatile time in the marketplace. I expect we could continue to see this volatility and exceed the market probably sometime before Christmas to set a new low on the S&P 500. We have some protection in our portfolio with our short position in SDS, and our greatest asset is the dividends that we're receiving off of the investments that we have. So cash flow is king. I know these times are unsettling. The volatility is very significant, and it makes you nervous. It makes me nervous. But be assured that I'm watching your assets and watching your portfolio and doing everything I can to minimize the decline as much as I can. You got questions? Please feel free to give me a call or send me an email. Thanks for watching.